of Jerome Powell to be the next chairman of the Federal
What
Reserve.
happens when the President of the United States starts threatening the independence of the central bank? And not just with words, but with plans to dismantle institutions, mass layoffs, and even open signals to fire the chair of Federal Reserve? In the past 72 hours, Washington has been heating up. But this isn't just a clash between Trump and Jerome Powell. It's a battle over who really controls the US economy and whether the world can still trust the dollar.
'I think he's doing the job. He's too late.
3 days ago, Donald Trump, now back in the White House, fired off a direct attack at Jerome Powell, the Fed chair. He said, "I'm not happy with him. If I want him out, he'll be out fast." And this wasn't just an empty talk. Trump has repeatedly suggested that the Fed should have cut interest rates much sooner. He believes Powell is too slow, too cautious, too textbook. In Trump's view, the current economy needs fast action. High interest rates are choking small businesses, slowing down credit, and most importantly, could ruin political momentum heading into the election. The problem is, the Fed isn't just another government agency. It's independent. Its job isn't to please the president. It's to maintain price stability and full employment. Two goals that often pull in opposite directions. What escalated tensions further was Powell's statement last week. The Fed would remain focused on fighting inflation, even if political pressure comes from the president himself. He said, "We will defend our credibility. We won't rush into cutting rates." Trump didn't take it well. He responded on Truth, saying, "Powell's termination cannot come fast enough." What's striking is that it is not just Democrats raising concerns. Senator John Kennedy, a Republican and a member of Trump's own party, said on national TV, "I don't think any president has the right to fire the Fed chair. The central bank must remain independent." That statement is a signal. Even inside the Republican Party, resistance is building. This isn't just about Powell. It's about preserving institutional sanity. But this battle isn't only about the Fed. Behind the scenes, the Trump administration is also dismantling key financial regulators, starting with the Consumers Financial Protection Bureau, or CFPB. This agency was created after the 2008 financial crisis to protect consumers from abusive financial practices. According to internal legal filings, 1,500 out of 1,700 CFPB staffers are set to be laid off. That's not restructuring. That's a near total purge. At the same time, Elon Musk's Department of Government Efficiency, yes, that's real, has taken over internal systems at the CFPB and began shuttering its Washington, D.C. headquarters. Meanwhile, the Securities and Exchange Commission, SEC, America's frontline market watchdog, isn't spared either. Over 500 employees have accepted early retirement or buyout package. Many regulatory rules put in place during the Biden administration, especially around crypto, are being eliminated or delayed. Senator Elizabeth Warren, who helped create the CFPB, didn't hold back. She said, "The cops are gone." And when the cops are gone, who's watching Wall Street? This isn't just about jobs. It's about removing the guardrails that kept bad actors in check. It's about loosening oversight at a time when economic uncertainty is already running high. The danger? When you got financial oversight, at the same time you are pressuring the central bank, you are not just deregulating, you are destabilizing. So here's the big question. How does this affect everyday people? In more ways than you might think. Consumers' confidence in the US has dropped 30% since December. Inflation expectations are at their highest since 1981. These aren't minor indicators. They were early warning signs of economic anxiety on a national scale. In macroeconomics, consumer confidence is a key leading indicator. When people grow pessimistic about their financial future, they stop spending. Big-ticket items, cars, homes, even vacations get delayed. That immediately impacts aggregate demand. As demand slows, the real economy gets hit first. Retail sales drop, manufacturing slows, supply chains stall, unemployment rises, companies freeze hiring, and a negative feedback loop begins. But it doesn't stop there. In financial markets, uncertainty around the Fed's independence causes bond markets to wobble. Institutional investors start to worry. If the Fed is no longer independent, will interest rate decisions become political? The result? They demand higher yields to buy US debt, and that means borrowing costs for the US government rise sharply. Imagine the federal budget getting heavier simply because markets don't trust the Fed. This is known as a risk premium shock. In IS-LM theory, the LM curve shifts due to volatility in money demand. In new Keynesian models, forward rate expectations become unstable. And when the Fed's forward guidance is no longer trusted, monetary policy transmission breaks down. Chicago Fed President Austin Goolsbee put it bluntly. Countries that weaken their central banks tend to suffer higher inflation, slower growth, and weaker job markets. And right now, the US is starting to look like one of them. In the medium term, the danger is profound. When bond markets lose confidence, capital outflows begin. The dollar weakens, and if that continues, the US risks losing the dollar's status as the global safe haven. If that happens, we may be entering a whole new phase of a global crisis. The US isn't the first country to face a showdown over central bank independence. Let's look at two case studies. First, India 2018. Back then, Prime Minister Narendra Modi wanted the Reserve Bank of India to ease up, especially ahead of elections. He pushed for reduced capital reserve requirement so that more credit could be pumped into small businesses and infrastructure. But RBI Governor Urjit Patel pushed back. He warned that lowering those barriers could lead to a boom-bust cycle and create economic bubbles. Modi wasn't pleased. Political pressure mounted. Indian media began questioning the RBI's authority. Even the finance ministry sent a formal letter demanding regulatory relaxations. The result? Patel resigned before his term ended. The rupee plunked. Bombay's stock market tanked. Foreign investors pulled out billions. India lost global credibility, not because of financial crisis, but because the central bank came under attack. Second, Turkey, 2021. President Erdogan had his own economic theory. The high interest rates cause inflation. Based on that belief, he pressured Turkey's central bank to slash rates even as inflation was already soaring. In 2 years, Erdogan fired 3 central bank governors, one after another, just for refusing to comply. The results were catastrophic. The lira collapsed, down more than 50%. Inflation hit 70%. Food prices surged. Citizens saw their savings vanish. Foreign investors fled. Turkey's citizens began hoarding dollars and gold. Businesses started borrowing in euros because domestic rates became irrational. The market began collapsing from within. Today, Turkey is viewed as one of the riskiest economies in the Euro-Asia region. This is what happens when political powers meddle too deeply in central banking. So the final question is this: are we witnessing the beginning of a slow erosion of America's economic institutions? If a president can freely pressure the central bank, dismantle regulators, and centralize monetary power inside the Oval Office, then this is no longer just Trump versus Powell. This is about the future of the global financial system. Because what gives dollar its power isn't just military might, it's institutional credibility. If that crumbles, the world will look elsewhere, and when that happens, the US could lose something far more valuable than interest rates: trust. If you think this issue matters, don't forget to like and share this video. Comment below, should central banks be 100% independent, or should presidents have some control? And I'll see you in the next one. Stay smart, stay skeptical. Bye.